founders tend to be the most optimistic people in the world, and that's both a feature and a bug. Founders, you can't build something unless you're slightly crazy. You have to just have irrational amounts of optimism and positivity. The counterbalance to that is that you may not notice that something is going wrong. You may not notice that that ship is a bit off balance. And I think the investor's role over here is to kind of provide that counterbalance, to always provide that gravity, to be like, hey, listen, yes, you're doing really well, but you forgot to pay your TDS last month. And that's probably the smallest example I can give. But it's ridiculously important because compliance with, I mean, just general governance and rules is really, really important.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Avik Ashar with us. Avik has been building or investing in businesses for the past 12 years. He is currently a principal at Artha Venture Fund, focused on early stage investments, seed to Series A in India. He previously ran a single family office for the Sutariya family based in Bombay, investing across India and SEA, and scaled Zilingo across 5 geographies, $100 million dollars in P&L responsibility with a team of 60, and raised $280 million dollars for the business. He also founded a SaaS startup in the auto insurance space that has been exited. In this episode, we talk about how Artha prefers a company friendly approach in contrast to the founder friendly approach that most VCs promise. How family offices, angel investors, and VCs use different lenses to look at prospective investments. How Artha's term sheet is different from others. Portfolio construction approach at Artha, and lots more. So, without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Avik, so good to have you on the VC10X podcast. How are you doing?
Hey Prashant, thanks so much for having me here. Quite excited, doing very well.
Awesome, awesome. It's a pleasure having you on. And to start things, can we first have your personal background story and how you started investing?
Sure. Give you a very quick one. So I grew up in the Middle East in Oman, moved to India, went to a boarding school because it's kind of a family tradition, and then moved to Bombay, did my degree in economics. Post that, I joined a lovely company called Direct Eye. It's kind of one of those unsung success stories in India, founded by the Durakia brothers. Obviously, I joined a decade plus after they had started it, so it was a great place to start my career. I moved out because I was poached effectively by a family office, the Sutariyas, and they were friends from boarding school, from very traditional industry, from diamonds and real estate. And they were looking at this proliferation and growth of startups in the Indian ecosystem. This is back into the end of 2012, beginning 2013, when the ecosystem itself was quite nascent. And they were very excited to invest in startups. I was one of the closest people they knew in the technology world. So after a while, I eventually made the shift. over from Direct Eye to Hirako, which is the name of their company, and built out Hirako Ventures. So at Hirako, we were a family office, which gave us a lot of flexibility. And I think there's actually quite a big difference in a family office and a VC, mostly from the patience in capital and also the ability to just go do effectively anything that looks interesting. Because as a VC, you typically have a lot of mandates, and I can come to that later. But as a family office, we literally did everything from pre-revenue, super early stage companies that were graduating from IIMM, the Buds Incubator, CIIE, all the way up to a large scale round into a company like Wellness Forever, which was already kind of a 200 crore revenue um, pharmaceutical chain with 55 outlets across Maharashtra. So led
Yeah.
the investments for Hirako for a little over 4 years. Did over 40 investments. Some of those round sizes were as large as like $3-4 million at that point in time, which I mean, 2013 were just massive rounds. That's like a Series A plus in today's parlance. So I was with Hirako for about 4 years, and then one of the things that really hit me was I wanted to get more experience in the operating side of building out companies. Like, at the end of the day, you can't really empathize with founders. You can't really understand unless you've literally been one or been in a startup yourself. So the Hirako folks were very understanding. They're still amazing friends till date. They were like, all right, please stay as long as you want. And if you find something that's really interesting, then we understand. So I ended up moving to a company called Zilingo, which today is a bit infamous, primarily for the fact that we raised a lot of money and then burned it. But it was an amazing journey. So Zilingo took me from Bombay to Bangkok, spent over a year there, then the next 6 years calling Singapore a base, but effectively spending most of my time across Asia. So, spending my time in Indonesia, Philippines, Vietnam, Thailand, India, Bangladesh, an amazing opportunity to travel and really understand what Asia was like. At Zilingo, I built up the B2B business. So, Zilingo, when I joined, was a B2C company, very similar to Mintra. And I built up the B2B business at Zilingo, scaled, had about 60 people under me. At that point in time, we went up to a little over 100 million in my department in like in GMV on an annualized basis, as well. Ended up raising about $300 million for the company. So, of course, me and a few others, we never used investment bankers across our funding rounds, and also led the acquisition of a $15 million SaaS company called Nsinga for Zilingo. So that was quite a journey. I think when I started seeing the cracks is when I decided that I would rather move out of Zilingo, because uh, when you disagree with the way a company is being run, you have two options. I mean, obviously, one is be you voice your opinion, and after you voiced your opinion, you either agree with how the company is running and continue, or you decide to leave. So I left. I ran into these two amazing co-founders, both with technical skills in Singapore. I came from the business side of things. We built a company called Jam, which was doing using AI and ML in the auto insurance space. So we were building software that goes into dashboard cameras that sit in cars, and through that we could connect to insurers and create customized insurance policies. So that went really, really well.
Yeah.
Scaled up quite significantly, and then we got a strategic offer from a UK-based company. So we ended up selling our IP. That was my
Yeah.
founding chapter. That was a pretty
Right.
crazy year.
Right. So there
And
you were an early employee, or you were an early employee there, right?
Jam, I started when I met the two founders. They had just come out of an accelerator, and I
Okay.
started for the first couple of weeks as an employee. But very quickly we
Mm-hmm.
aligned and understood that they need a business co-founder. So then I stepped up to co-founder, and then basically led a lot of the partnership conversations that we were having with
Got it.
insurers, fundraising as well. All of that was under me.
Awesome. Awesome. Incredible. And now you are working at Artha. So tell us about why you choose to join Artha and what are you doing here?
Sure. So Artha is very close to me because the founding partner, Anirudh Damani, and I used to actually co-invest together from 2013. He was running his own family office back then, and that's probably a bit of the history of Artha as well, where Anirudh and I had very similar journeys, except his was significantly earlier. He had moved to the US, done his degree there, worked in the energy, the renewable space specifically, then ended up building a company there and then selling it. A lot, the call to come back to India was very strong for him back then. So he moved back to India and then used obviously a lot of the capital that he gained from that sale as well as some family capital to invest in startups. And he had built up a pretty significant portfolio. By 2016 or 17, he had built about 60 companies, including companies like Oyo, Purple, and exited them at the right times as well, which I think is part of the art. And by 2019, he started Artha Ventures. So effectively, Anirudh had been investing from his family office. He then co-invested with a lot of families, including families like DSP, Kirloskar, Morde, and more. And then he ended up creating Artha Ventures, which is the first one was a $33 million fund. We then created a winners fund, effectively for our follow-on capital, which allows us to stay with our companies till Series D of $50 million. We are currently in the middle of fundraising for Artha Venture 2, which is a $50 million seed fund. Very similar philosophy to the fund 1. I can go into the fund philosophy later. And we're already deploying.
That's very interesting. So this is the same fund that's going on from 2013. So that was a family office. Now is it structured as a venture fund?
Yes, so family office in 2000, end of 2019, he restructured, and basically built a Cat 1
Okay,
venture fund. Now it's now what we've got it for Artha Ventures 2 is a Cat 2.
awesome, awesome, great. So you have been an investor at a family office before, and now at a venture fund. What's the basic
And,
difference? Do you?
and middle, I've also done about 7 personal investments. So
Yeah, so also an angel investor, right? So
yeah.
give us an insight into how do you evaluate startups from different lenses, from being a family office person to being an angel investor, now to being a VC investor.
Actually, yeah, really interesting point. So I think a very important thing to run through, and I guess most folks listening to this would probably have some idea, but a VC fund effectively has to shoot for a very different kind of return profile than an angel or a family office. Because I mean, an angel and a family office, it's your own money which you're deploying, and hey, as long as your return is beating kind of what you're going to get in the market, if you're getting kind of a 25% IRR, you're not doing too badly. Of course, risk adjusted, you'd probably want more, but you're okay with putting smaller checks in and also receiving, I mean, working towards smaller outcomes. However, as a VC fund, the entire point is that we're structured in such a way that we are expected to give back a pretty significant return to limited partners, especially because I mean it's a very high risk category. So I think the biggest difference in my lens, the first one was I suddenly had, I wouldn't call them rules, but I call them guardrails, where we have a fund mandate, which basically means that we have a certain amount of percentage that we need to own because of the way we have structured our fund and our thesis. We have a certain valuation that we obviously can't go beyond because we also have a fixed check size. In at Hirako, I mean, the check size could effectively range anywhere from 50 lakhs to 5 crores. It was completely dependent on how the family and I viewed the business and whether it needed that kind of capital. In at Arthur Ventures, I can't look at businesses that don't sit within our mandate. So I think one of the hardest things for me as someone who just loves virtually every startup I come across, I had to learn very, very quickly to say no a lot more. And the words "it's
Right.
out of our mandate" was hard getting used to
Yeah.
it.
Totally. That's very interesting insight there. That at a family office or as an angel investor, you have a lot more freedom in the kind of investing you can do, in the kind of startups you can back. While in a VC fund, there are set rules for how you deploy your money because that's what's been communicated to your limited partners and that has to be followed, right? So you
Exactly.
cannot be too opportunistic on that front. You have to follow the rules. Yeah.
It's, I mean, every fund typically gets a little bit of leeway. So here we have about
Mm-hmm.
20%, where you can go a little bit out of mandate. But again, if you're going out of mandate, you better have a really, really good reason why. Because if that doesn't work out very well, your LPs are going to come back and be like, hey, what happened?
Right, right, right. Very true, very true. So, when you are evaluating startups, maybe across all the three different ways you've been investing, what have been the common things that you look for that are important in a startup that make you interested in them?
Nice one. I think the common things haven't changed at all from the time I first started investing and kind of learned the rules of the game from a lot of the existing investors back then. They were mainly angel investors at that point. I have to really thank a lot of the early folks in the ecosystem. I mean, people like Rajan Anandan, who run Surge today, Anupam Mittal, they were all kept meeting them at conferences, and they were so happy to meet up for coffee and explain their philosophies. They were some of the most active angels back then in the early 2010, 2015 era. And they were very, very happy to share their thought processes, how they looked at evaluated companies. I think that one takeaway was I just kept asking people to have coffee with me, and they just said yes. And they were very happy to share their thought processes. And from there, I built a lot of my own. I think the crux of it is the founder fit. So in early stage companies, there's really not too much to evaluate. I mean, a few crores a year is not really enough to tell you whether that business is going to succeed or not. So it comes down to, hey, does this founder really, really understand the problem that they're going after? Why are they doing it? The why is a very, very big one for me. The second thing comes down to how do they run a company? And here is something a little counterintuitive, where everyone looks at entrepreneurs and entrepreneurship as kind of a young person game where, hey, drop out of college and build a company. The reality of it is, and especially if you look at the data, the reality of it is most of the successful startup founders in the world, including India, tend to be over 30. Late 20s to early 30s is kind of when they've started their companies.
Right,
And
right.
for me, that comes down to the fact that they've gotten a bit of maturity under their belt. It's you've learned a lot of the soft skills, because over time, being a CEO or being a CXO at a company, it's much less about your hard skills. You don't if you better not be making Excel models at a Series A level CEO, but learning to manage a team and scale a team and basically keep people's morale up, make sure that you can build departments that can operate and help each other rather than create incentive situations where people want to fight. That those soft skills are just so much more important to be able to really build a lasting company. So I think folks who've been through a bit of the grind in the corporate life, or at another startup, kind of seen a lot of that, uh, learned a lot of those soft skills through that, made some mistakes, and then come made some mistakes on somebody else's money, and then come and and then come to raise funding from me. I'm a lot more comfortable. I'm like, hey, everyone makes mistakes. I think the fun is that you've made those mistakes and now you've learned from those and you're coming to raise money. And you also have a very clear understanding of the problems that you're trying to solve. When you work for, let's say, a decade in a particular industry, you have a fairly good idea of what that industry is like, what are the existing solutions, what are the blank spaces, and what's needed. You also have the ability to pick up the phone, call up five people across that industry, and be like, hey, this is something I'm building. Is this interesting? Would you try it out? Let's pilot. And then they'll become your first customers. So, founder market fit, maturity, and then obviously the numbers do tell me something. I need to see founders who understand their numbers, because at the end of the day, numbers do make a business to a large extent. If you understand exactly where you're spending, where you're earning, and what is going to take, what are strategic spends versus what is just slightly crazy burn, and what's going to get you to the next level, that really matters to me.
Absolutely. Very interesting insight there, and especially on the point of maturity of founders and getting some experience under their belt before taking the leap. I was recently talking to a youngster who's still in college and was wondering if I should go and do a startup or should maybe get some experience, right? So the advice I gave them was similar to what you just said, that although there are some success stories of super young founders making it big, like the Zepto founders, there's Zoyo. I do feel that these are very few in number, but they are over glamorized. But if you look at the overall data, it says, like you said, that people over 30, or I've seen data of even over 40, that's where majority of successful founders are actually found. So it certainly says that some experience under your belt is a plus for you, and that definitely helps in getting you success while building a business, right?
Yeah.
So for young folks listening, that's important takeaway for you. Yep. Awesome, awesome. And so you were investing before, and then you went in, joined a startup, saw that early grind, then are back into investing, right?
Yeah.
What has changed in your investing approach from how you were doing it before to how you're doing it now, from the learnings you got from operating at a startup and the mistakes you made there?
That's a really, really good one. I think definitely when I look back, and you always look back, I mean, as much as you want to look forward, looking back, I think the amount you can learn from history is really important. And whenever I look at investment decisions I made at Hirako, and I mean, some of them have turned out really, really well. For example, we went into a company called Farai back when it was raising its seed round, $2 million valuation. Today, they're over half a bill. So definitely we made some uh, good decisions, but I always love analyzing the ones where I'm like, hey, what did I do here with the information that was available, and could I have made a better decision at that point in time? I think one of the major ones is, and maybe this will be a bit cynical, but it's about understanding the way venture works, understanding the way startups work, understanding what exits are like, and what future fundraising rounds are like. You may absolutely love a company, but if it's a company that's going to be dependent on burn for the next 4 rounds, let's say a deep tech company like in the defense or space, because speaking of space, I mean, we're early investors in Agnikul, and recently we were just jumping. I mean, I can't explain the joy in the office when the Agniban took off. And that's just a lot of faith that paid off. Investors thought we were crazy. In fact, there were a whole bunch of investors. We did buy a lot of secondaries in the last year running up to this launch. We had a whole bunch of other investors in Agnikul who were just like, "This is never going to take off. It's never going to happen." And we were like, "Okay, we have faith. We'll buy you out." So we
Yep.
definitely maintain that. And
Mm-hmm.
what it comes down to is you really need to spend some time understanding who the people are early
Mm-hmm.
stage. And also, sorry, I was coming back to, if a company needs to burn for the next four
Right.
rounds, you need to understand who's going to support that burn. Do
Mm-hmm.
you have the capability to? And I mean, that's also, we can get to it later about how we've structured Artha, but we have structured it in such a way that we want to be able to keep supporting founders at every stage. We have follow on capital. After our seed round, we actually reserve most of our money for follow ons to make sure that if a company is really struggling at a bridge round, but we know that we have conviction that they're doing something right and they just need that little bit of capital to survive, we are able to deploy it. So coming back to that, one of the things I've realized is you have to reverse calculate a little bit when you're looking at this from a VC hat about who's going to be your next investor, how is that going to play out, and assuming that you want to be the next investor, what is it that you want to see this company go towards? The second one that I used to really not appreciate enough was the role that compliance and discipline have while working with startups. I used to always have my monthly chats with founders. It was always a very happy one, like, "Hey, what's going on? Is it amazing? What have you done that's cool?" Because I wanted to hear what was cool. Now, I mean, I'm like, "Hey, send me anything cool in a WhatsApp update." Whenever we do our one-on-ones, which is a monthly basis, I want to hear what's painful. I want to hear what's, pardon my language, shitty. What is going on that could kill your business in the next week or in the next month or in the next 6 months. Those are the things that I really want to focus on and spend my time on and figure out how I can help that company solve it. And I think founders tend to be the most optimistic people in the world, and that's both a feature and a bug. Founders, you can't build something unless you're slightly crazy. You have to just have irrational amounts of optimism and positivity. The counterbalance to that is that you may not notice that something is going wrong. You may not notice that that ship is a bit off balance. And I think the investor's role over here is to kind of provide that counterbalance, to always provide that gravity, to be like, hey, listen, yes, you're doing really well, but you forgot to pay your TDS last month. And that's probably the smallest example I can give. But it's ridiculously important because compliance with, I mean, just general governance and rules is really, really important.
Absolutely, totally agree. And an important role of an investor that's highlighted, that's often not talked about when we talk to investors about what's their role and how do they help startups. I think this is one important one. And this is coming more to the focus now with increasing regulations and some crackdowns on some companies. And it's great to see investors taking lessons from that, right? And you made a post on LinkedIn talking about how investors keep talking about that, oh, we are founder friendly VC, we love founders, right? And you said we need not be founder friendly, instead we should aim to be company friendly VCs, right? So tell me, what's the difference between the two?
Really love that. I mean, this is something I never actually coined it that well until I was it was literally in a chat with Anirudh that we were discussing it, and we were just talking about the entire. I think it's about a year and a half ago, way before I decided to join, and we were talking about this entire founder-friendly wave, where people are just waiving their terms, waiving their conditions, and also allowing founders to just raise evaluations that didn't make sense for the business. And that's why we came down to it. And the entire concept of Artha is that we are company friendly, that we are trying to make the best decisions to make the company prosper. Ideally, you want to make sure that the founder and the company are completely aligned. And unfortunately, we've seen, I think, several cases now, especially in the Indian ecosystem, where the fate of the founder and the fate of the company are significantly different. And by the company, I mean all the stakeholders that the company affects. You're affecting hundreds, thousands of employees, various vendors in the ecosystem especially sometimes small to medium businesses who've lent their services, who've sold products to startups that suddenly just raise their hands and be like, hey, we can't pay you anymore. Go fight it out while the founders are relaxing in Dubai. So I think it's really, really important to uh, frame this as a focus on this is not an attack. This is not saying that, hey, we just want founders to suffer. It's that we want founders' fates to be very closely aligned positively, ideally, to the success of this company. And based on that, how do we really make sure that there are enough guardrails? How do we make sure that the terms are stringent enough? And then obviously that we are enforcing those terms. Like, I'll give you an example. We literally check on a monthly basis. We look at the MIS data of companies. Of course, if there's a few percent points variance here and there, that's part of life. Nobody can plan it down to the T. But if there's a glaring amount of variance in something, we're going to jump up and be like, hey, I think you should probably take note of this. These expenditures seem a bit irrational. And in fact, this conversation led to something that we're doing that's really fun across the Artha portfolio. And I'd love to actually do it for maybe a few companies that reach out, where we realized that there were a whole bunch of tools ranging from hosting, cloud hosting, to software tools, where our portfolios were negotiating on an individual basis and everyone was just not getting the most optimal packages. So now we're basically building that out at an Artha level, where we have over 120 portfolio companies today, where we're saying, hey, can we come in? Can we consolidate kind of all of your requirements and then go and group negotiate a license for you? So that's some ways that we really think that VCs can add value as
Right.
well as kind of help founders keep an eye on the bottom line.
Very true, very true. Certainly, that's very interesting. And again, talking about the fact that sometimes the company might not work out. The outcome for the company might not be great, and as a result, for the VC, it is not great. But okay, sometimes it happens that the founder wins out big, still, right? So that's something. Definitely something wrong there, and that's certainly about not getting the terms right and the founders tilting rules in their favor to for personal interest, which is not great, right? Uh, awesome. And one thing I've also read on your LinkedIn is that Artha's term sheet is also very different from most term sheets founders would see from other VCs. So tell me what is different about Artha's term sheet.
Absolutely. So, for people who aren't too familiar with it, I put up an even deeper post recently. Because when you look at a shareholders agreement, there are always going to be a whole set of rights that are called effectively reserve matters or definitive rights or affirmative rights. These are a bunch of rights, namely all the way from hey, the budget has to be approved with the board, which comprises of investors. Investors, if you want to spend more than X amount of money outside the budget, investors have to approve. If you want to start a subsidiary company, investors have to approve. I mean, there are about like 30, 35 different points that typically come in here. And most VCs just end up doing this negotiation all the way down at the shareholders agreement level. This is probably when you're maybe 2.5 months into a fundraising process, usually after the due diligence has been complete. Suddenly, you then wake up and start negotiating, not wake up, you start negotiating these really, really critical terms. And a lot of times when sometimes investments just fall out because of those terms where maybe there's just not a meeting of the minds or an alignment on those terms. And I think that it's really critical to do that upfront, because when a founder is fundraising, you typically, sure, you ideally should have at least 6+ months of runway. I'd say even more if you can manage it, 8 months plus. But usually you're getting a bit tighter and tighter on your runway. Now, if that eight has suddenly become five, or heaven forbid, if that five has suddenly become two, and then suddenly a VC is like, hey, by the way, these are 30 terms I want, and this is the way I want them. You don't have much room to negotiate. You don't have too many places to go. So we really prefer just putting that entire thing with upfront, kind of within the first 2 3 weeks of our interactions and discussion, so that we can very quickly be like, hey, you're not under a gun, you're not under pressure. Take your time, think about it, come back, let's have a mature discussion about this, align on those terms, and then if we do align, brilliant, then we move forward. So we kind of front load that process, which actually means a lot of founders just be like, yeah, okay, we don't want to talk to you. They're giving us a two-page term sheet. I'm like, yeah, but just wait till you get to the SHA.
Right, right, right. Totally agree. But does that not make founders go away from you at the top of the funnel? Does that not
I
reduce the
don't
amount
mind.
of deal flow you're getting?
I
Yeah.
genuinely think that it's kind of a filtration by itself. I mean,
Okay.
recently, I obviously can't go into names, but recently I was having a chat with the founder where we are moving ahead, and I had shared our term sheet up front, and they were like, they looked at it and they're like, can you spend an hour running us through each and every term, explaining what this is for and why it
Mm.
exists? And my entire point was, hey, listen, these are going to come in now or they're going to come in later. The second thing is that these are guardrails. If our relationship ever breaks down to a point where I have to email you that as per this clause, I think that there's just so many more problems that are happening with our relationship, the company, and everything, that it's going to really be bad. So, and they responded that, hey, we've come from the finance sector. They were working deeply in finance, and they're like, we are used to being even more strictly regulated than this. We love being regulated. Let's go.
Yeah. Got it. That's interesting. Awesome. And another thing that you've talked about on your LinkedIn, so a lot of interesting LinkedIn posts on Avik's
Thank you.
profile. So definitely go follow him on LinkedIn. I'll put his link there, right? So one was about how DTC brands, direct to consumer brands, are fighting the incumbents and try to get a market share. And you did sort of a comparison on that LinkedIn post and how that fight is faring out. So tell us more about that.
Sure. So, I mean, I'm not going to go into the brands because it wasn't trying to single anybody out. It's just that I lived in Singapore for the past, I mean, out of India for the past 7 years. For me, coming back is kind of a new world almost. I'm just looking around and everything has completely changed, down to who the sponsors of IPL are, which is kind of a great parameter or benchmark. It's almost 50%, maybe more, leaning towards like digital or new age brands that have just been built under the last decade. Everywhere I look around, advertising, things that my friends are talking about, things that people are using, even down to fashion now moving. I'm still an old school person. I just go buy one brand and buy like 20 polos in the same one. But I'm seeing people like just innovating in fashion. And I was like, the fastest way I can immerse myself is just replace everything I use in my daily and household life with new age brands and try them out and see what they're about. And that was what it was about for me. And I think the crux of that conversation was, are you doing something that's different? Are you doing something that's like, are you innovating? Are you creating something that wasn't there before? Or are you improving on something that was there before? If you're doing neither, at least the third is, are you significantly cheaper? Then maybe you're addressing a different kind of consumer, which they're just a whole bunch of aspirational consumers in India looking to kind of up what they were using and start using different things. My feeling is, if you're doing none of those three, you definitely kind of need to question what your value proposition is to users beyond marketing budgets.
Absolutely, totally agree on that. And does that also come significantly in focus when you are evaluating DTC startups? Because we have a lot of startups doing more or less similar things. Let it be fashion, it can be, foods, eateries, right? Snacks, healthy snacks, different kind of categories there. So a lot of brands have emerged, right? So how do you find which one is going to win out the market share, right?
I mean, that's the hardest one. If I could,
Hmm.
if I had a perfect answer for that, I'd, I'd be the world's best.
Yeah,
Um, Definitely don't. But
yeah,
I think it's about finding kind of your niche, and a lot of times, and this kind of flips back to my investment philosophy. I'll have to go back there for a second. I hate the answer, and I almost never give the answer of this market isn't big enough. I hate that answer. I'm like, if this market's throwing a hypothetical number, 100 million, but it's served by maybe two other people, and you're telling me that I'll take half that market because I'm just that good. I mean, like, yeah, that's great. That's a brilliant outcome for me as a VC. Because we are early stage, so 50 mil will probably give me like a 200, 250, a little bit more outcome, assuming it goes well. And I'm like, that's great. That's a great answer because building your community, finding the people that love you, die for you, believe in you, and just like, if I love to say it. If you go away today, if you're a brand, and if you disappear today, will people be really, really, really upset? And I know this first. I mean, there's some brands that I resonate with like that. When they left the market, or they shut down, or maybe I moved from a market where I can't get them. Like, I grew up in the Middle East in Oman. I've lived across Southeast Asia. There's still brands that I desperately source, and whenever anyone's traveling from those countries, mainly food. Uh, but whenever anyone's traveling from those countries, I'm like, I just need you to get those for me. I'm that diehard a loyal fan, and that probably is never going to change. So,
right.
what is when you're building a brand, if you can build that community and then build around it, that's kind of what is a brand for me. And if you can build that community, I will probably invest in you.
Absolutely. Have you invested in any of those who are doing that well? Would you like to name a few?
From the Artha portfolio, I think one of the really amazing ones that we have on the retail side. Ironically, it's not a, it's a silent brand. It's a company called Dalchini, and it operates over 1,600, almost 1,700 vending machines today, ranging from corporates like Amazon or Reliance or Google or Microsoft, down to plants again like Reliance, and then Bale and a whole bunch of other and ITCs manufacture contract manufacturing plants, and they have vending machine deployments across these places, and they're kind of a center for different brands to be able to showcase their products. And sure, if you ask someone, "Hey, what's the vending machine brand in your office or in your plant?" They might not know it, but B2B within like HR managers or office managers, they've really built a network. Now, office managers actually send messages to each other, and I've seen a few groups where, hey, we want to solve food in the office. Okay, get a Daljini machine. So that's one pretty
Yeah,
funny.
yeah, totally. Very interesting. And let's talk about portfolio construction. So, how do you think about that at Artham?
So at Artha, we really believe that we want to go deep. We're not one of those funds that does 50, 60, 100 investments a fund. Fund 1 was 31 investments. Fund 2 is projected to be 32. We're going to go up, down a couple, but that's roughly the number that we're going to stick at. And the way we construct is we go in at seed, and that's where we really want to take a meaningful kind of stake. We like being on boards. We like being playing a very active role with companies, and we keep a certain amount of capital for seed investments. Then we keep almost, I can give you a rough range, so between like 30-40% of the fund is effectively at seed, and then another rough third is for pre-A, and then a third is for A. Pre-A is not something that always happens. Pre-A is what I also call a bridge. We keep that second reserve because there are a lot of times when companies are doing well from seed, but they're just not ready to raise a full-fledged Series A. I mentioned that earlier, where they might be doing well or they might be struggling a little bit, but we believe in them. We're like, hey, whatever you're doing, you're about to release a new product or do something cool that we feel will really change the game. We make sure that we have that mid-level funding to bring them up to the Series A. And if they don't need it, then we just take that entire amount and shove it in at Series A. So then that's just a massive check that we go in with at Series A. Over and above that, we purposefully raised the winners fund because we realized that there were some companies that would take a little bit longer to mature, but when they mature, oh my god, these are going to become big companies. Like, they can go all the way up to becoming like those. Okay, I hate the word unicorn because it's pathetic. I just think really, really nice big businesses.
Right.
We keep a second fund so that we can invest at Series B, at Series C, all the way up to Series D.
Got it. Got it. Very interesting. And my last main question before we do the rapid fire round is about how what's the change that you're noticing in how VCs are looking at startups in India in the last 3 years as compared to the vintages that were before that, right? Before COVID period, maybe, right? So what has changed, and how are you looking at startups differently now?
So I don't think that the way I look at it and Anirudh looks at it and the Artha philosophy has changed at all from the time we first met in 2013. Um, we were always fundamental driven. He was an operator back then. Now I have the operational experience as well. We've not changed the way we look at companies ever, which is a business's goal is to make money. Uh, help stakeholders, improve ecosystem around you, but this is a capitalistic ecosystem. A business's goal is to make money, and that has never changed for us. I think what did change was this period. I like to call it a fever dream. This period where profit and revenue and unit economics, these were just words, they became dirty words. They were words that nobody talked about, nobody looked at. They're like, what's your growth? How are your users improving? What's your top line like? What's your GMV? And I think it's basically reversion to the mean. Today is basically a return to reality from that kind of dream. So that's what I think is happening in the ecosystem, and that and this is kind of shocked a lot of people who've probably not seen the ecosystem before that, or because for them, I mean, I can't blame them if you've grown up, I mean, matured in the 2016, 17, 18, 19 kind of era where you just suddenly saw that, hey, spending a lot of money, raising a lot of capital, burning a lot of capital, valuations that just become 5 or 10 times every 8 months is reality, then today it really hurts because that's what you thought was reality. I think what's happening today is that venture is returning back to reality, and it's really important for all everyone in the ecosystem to kind of understand that.
Absolutely, totally agree on that. And now let's do the rapid fire round. I'll ask you six quick questions about the investing you're doing, and you have to give six quick answers, right?
Okay.
Awesome. So the first one is, what are the sectors and regions you invest in?
Every and regions is India.
Okay. So what's the typical stage of investment?
Seed.
Do you lead rounds?
Yes, we actively look to lead rounds.
What's the typical check size you put in?
Typical check size is 4 to 8 crores. First check,
Okay.
and then we'll see we go doubling down.
Okay. Where can founders apply for funding in case there's a direct way?
So we don't have a direct form. You can always reach out to us via social media, LinkedIn. Though the best way to reach out to Artha is through a referral, either someone who knows us or a portfolio founder, one of our portfolio founders.
Got it. Last one. Where can our listeners follow you?
Oh, they can follow me on my LinkedIn. I also have the link to my Substack on my LinkedIn as well, so you can follow both.
Awesome. I'll make sure to put all these links in the show notes below so that our listeners can get there easily. Thanks so much for making time for this, Avik, and I wish you happy investing.
Prashant, amazing. You've been a wonderful, wonderful host. Thank you so
Thank you.
much.
Thank you so much. My pleasure.